$10,000 of your portfolio could vanish in 30 days, and most couples don't see it coming. The US-Iran deal negotiations are heating up again, and Wall Street is pricing in volatility. Here's the uncomfortable reality. If you believe this geopolitical crisis won't touch your retirement account, you're about to learn why that belief is costing you money. By the end of this video, you'll understand exactly how the Iran deal triggers market shocks, which sectors get hit hardest, and the 3 portfolio adjustments that research shows actually reduce losses when tensions spike. This matters right now because the current negotiation window is creating uncertainty, and uncertainty is where portfolios bleed. Let's start with the core risk. According to SEC research, a 10% stock market correction, which is historically mild, means a $10,000 loss on a $100,000 portfolio. That's not a hypothetical number. That's real money tied to your retirement timeline. Now add geopolitical risk on top of ordinary market volatility, and you're looking at acceleration. The S&P 500's historical average return is roughly 10% per year. But during geopolitical crises, think 2011 debt ceiling standoff, 2014 Russian sanctions, 2020 COVID shock, that return compresses or reverses entirely in weeks. Here's where most couples get it wrong. They assume the Iran deal is foreign policy news that doesn't affect their Vanguard account or their 401k. That's the belief gap we need to close right now. The reality is that Iran sanctions negotiations are oil price negotiations. Oil prices drive inflation expectations. Inflation expectations drive bond yields. Bond yields drive stock valuations. Your portfolio is downstream of every single one of these links. The numbers tell the story. When the original JCPOA was signed in 2015, oil prices were already under pressure, but the deal accelerated a 25% decline in the energy sector that year. Conversely, when the US withdrew from the deal in 2018, oil spiked 15% in a month. Brent crude jumped from $65 to $76 per barrel. Downstream, airlines margin compression, consumer discretionary pullback, and a 19% correction in the S&P 500 by December 2018. That's not coincidence. That's contagion. Now the hidden risk most portfolios miss: concentration. If your $100,000 portfolio is weighted 60% equities, 30% bonds, 10% cash, and those equities are heavily weighted toward tech and financials, you're underhedged against oil shocks. Why? Because when oil rallies due to Iran uncertainty, energy and utility stocks outperform. But growth stocks, the ones most people overweight, often underperform. This creates a performance gap. Studies on sector rotation show utilities gained 18% in 2011 debt ceiling crisis, while tech returned just 3%. That's a 15 percentage point gap. On a $60,000 equity allocation, that's $9,000 in lost upside. So what actually works? First, rebalance toward inflation hedging sectors, not panic buying commodities, but tactical 5-10% allocation to energy and utilities. Second, widen your bond ladder. Long duration bonds, the ones with 10+ year maturities, gain value when equities sell off and flight to safety buying accelerates. A 30% bond allocation cushions the volatility. Third, stress test your portfolio against a 15-20% equity correction. If that correction would erase your near-term goals, your down payment in 18 months, your child's first year of college, then you're overexposed. The math is straightforward. The research confirms this. According to Federal Reserve analysis of post-2008 portfolios, couples who maintained a 50/50 stock bond mix weathered geopolitical shocks 40% better than 80/20 allocations. That's not conservative. That's smart. And for a $100,000 portfolio, a 40% better outcome is worth $4,000, $6,000 in protected assets during a crisis. Here's the bottom line. The Iran deal uncertainty isn't going away in the next 60-90 days. Congress is debating sanctions. Oil futures are pricing in volatility. Your portfolio should be positioned before headlines escalate, not after. That means reviewing your sector weights, testing your bond allocation, and confirming your cash buffer today. If you want the full numbers and the implementation checklist, the deep version is in the companion book Market Cycles Decoded, link in the description. The biggest takeaway: geopolitical risk is quantifiable and it's hedgeable. Markets reward the prepared. Hit subscribe for next week's video on tariff cycles, dropping Thursday, and ring the bell so you don't miss it. What's your biggest concern with your current portfolio? Drop it in the comments below.